I'd like to begin our consideration of the accounting standards concerned with assets with a focus in the first instance on accounting for inventories. This to me is a very natural place to start because the accounting issues that arise with respect to inventory are, I believe, relatively straightforward, and they're addressed in just one accounting standard, IAS 2, or in Australia, AASB 102. Whenever you start to think about how an asset might be accounted for, you need to make some initial decisions or choices as to what you expect to see. Is the asset going to be accounted for on an historic cost basis, or is it more likely to be accounted for on a current value basis? And current value often means fair value. In terms of determining whether you expect an asset to be accounted for on an historic cost basis or a current value basis, there's no strict guidelines for how that decision might be made, but it's going to encompass things such as what is the nature of the asset and what is the business model. It's going to reflect the duration for which the asset is held and the extent to which there might be material changes in the value of that asset expected to occur. Now, in the case of inventory, which is held for resale at a profit, it's usually held for relatively short periods of time, and their value is unlikely to change significantly over the period for which it's held. That would probably suggest that it's going to be an historic cost approach to accounting for inventories. A further very practical issue is that if it is going to be a fair value standard, you'd have to be asking the question of, well, how would that fair value be determined? And can it be determined in a way which ensures that the number is relevant and cost effective? I think that's quite problematic in relation to inventories. So my expectation when it comes to looking at the accounting standards concerned with inventories is that I would be expecting an historic cost standard, and the accounting standards are going to have to address the issues of what costs to carry forward, limits on the costs that can be carried forward, and recognising the costs. So let's get into the standard, and what we're going to be focusing on here is AASB 102, IAS 2. The first thing you need to focus on is where the standard describes its application. And this is often done through definitions, and we can see this done in paragraph 6, where we describe what assets are. We have a definition of inventories. Inventories are assets which are held for resale, so inventory sitting on the shelves of a retailer. In the production process, work in progress, materials consumed in the production process, raw materials, or maybe materials which are used in the provision of a service. So clearly this is part of the firm's business operating cycle. There are some exclusions: biological assets, financial instruments, and the exclusions are probably going to signal to you that this is because they're addressed in a different accounting standard. Now, if this is going to be an historic cost standard, the first thing it's going to do is to establish limits on what costs can be carried forward. And this is done quite succinctly in paragraph 10, where we have a definition of the cost of inventory as including the costs of purchase, cost of conversion, and other costs in bringing the inventory to its location and condition. This is clearly setting up a class of costs. We're also given the idea of how we might allocate or determine the cost of individual items of inventory. It might be done on the basis of specific identification of inventories, or alternatively it might be done on the basis of some allocation process such as FIFO. Critically, what it tells us at the end of the day is that when we think about inventory, at the end of the day it's going to be a combination of the cost of purchase of the inventory, the cost of conversion, and other costs. So quite obviously it's going to be advocating for not direct costing but absorption costing, and you'd expect to see a journal entry like this where you can see the overheads being carried forward. What does this mean? Well, the standard goes into some significant explanation as to what type of costs can be carried forward in terms of inclusions. Import duties are obviously getting the inventory to its location. You can't import the inventory into the country without paying import duties. Shipping costs are getting it to its current location. Overheads in the manufacturing process, obviously costs incurred in getting the inventory to its location and condition. There are going to be some exclusions, however. Waste obviously has to be excluded. Storage costs don't change its location or condition. Insurance protects its value. So what we can see arising here is that it's creating a class of costs which might be aggregated and carried forward as inventories. A surprising one is that sometimes interest might be able to be carried forward, and that's addressed in paragraph 18. The second aspect of any historic cost accounting standard is going to impose limits on the costs that can be carried forward. In relation to inventories, we see this clearly in paragraph 9, and this identifies the fact that inventories should be carried at the lower of cost or net realizable value, paragraph 9. The issue here is that inventories, the benefit of inventories are realized from its sale, so obviously you can't recognize inventories at a cost higher than which you can sell it, less the costs for resale. So the standard goes into some significant discussion as to what net realizable value means, and we determine this on an item by item basis, paragraph 29, and reversals are possible. When we say item by item, what this means is you don't work it out in total. So if you look at the tile on the side of the screen there, you can see that whilst we might have an aggregate net realizable value of $63 and an historic cost of $60, because we're doing it, that's not relevant. Because we do it on an item by item basis, you can see that on an item by item basis the lower value is 57, and we'd have to write down our inventories by $6. That's the consequence of doing it on an item by item basis. Now, it is useful to say that that is by definition conservative, and whilst we don't actually have conservatism in our framework, it's one of those things you should probably look for in a lot of accounting standards, and don't be surprised when it appears. In terms of recognizing the cost of inventories, this is addressed in the first instance in paragraph 34. It says that you recognize the cost of inventories when those are sold. When they're sold, that's cost of goods sold, and you're going to be recognizing the cost of inventories if they're written down as well. In terms of how you determine those costs, obviously there's going to be a cost formula, again applied if you can't specifically identify what's going on. Reversals are possible, and so if you've had a reversal, if you had a write down and it's reversed, that also goes through the income statement profit loss as well. There are quite significant disclosures in relation to inventory, and these are disclosures of accounting policies for inventories, the cost formula approach, the carrying amount, and inventories recognized as an expense. There's also the requirement to recognize inventory write-downs. So accounting for inventories is relatively straightforward. It's addressed in one accounting standard, and in that one accounting standard we have the three fundamental issues addressed. What are the costs of inventory? Any limits on the cost of inventory carried forward, and how we recognize those costs in the statement of profit or loss. Thank you.